Joining us now, David Bahnsen from the Bahnsen Group and Michael Farr from Farr Miller in Washington. It's great to have both of you here. David, I'm going to start this conversation with you because we have seen dip buying. We have seen a little bit of a rebound here, particularly in some of these big tech names into month's end. You're saying don't buy the dip. Why?
Well, I think that the names that have dipped the most are grotesquely overvalued, and they could easily catch a bid and rally, but it's entirely speculative. When something is trading that far above a rational valuation, it becomes impossible to know if you are buying a dip or just simply buying a lower price. There's a big difference. And I think you look at NVIDIA, market had a little bit of a recovery the last few days, but I mean, it's a substantial drop. It had a nearly 20% drawdown in the middle of the month on really, really good news, not bad news. There was nothing disappointing. It's just an expensive stock in a counterparty situation with something that most people cannot economically explain or rationalize. It doesn't mean it won't go higher. It just means you're speculating, not investing.
Michael, I mean, we had a 5% pullback essentially in the month of November, more volatility than we usually see in the month of November. But how does it set us up for December, which is seasonally a pretty strong time of the year? I'm looking at your notes here. You say that portfolios are as hard to manage at this year end as any time you can remember in your career. Why?
Just for what David Bahnsen said, when you get somebody as experienced as my friend David, you really have to listen to him. And I think his point that even though the price is lower, doesn't mean that it represents good value. So we're trying to manage portfolios. A lot of them have really increased over the course of the year in some rather concentrated positions, which leaves portfolio managers in the position of trying to figure out how they're going to manage risk, how they're going to manage the taxable consequence of selling, trimming, and doing what we need to do. And then third, where do you put money and where do you find value? And you better be sure you're not just buying one of those lower prices at a really exorbitant multiple, as David suggests. So it's kind of a tough time to do it. I think additionally, the markets have created this narrative, Morgan, for the Federal Reserve, that somehow, based on two words from the New York Fed president, as Roger Ferguson said on Squawk Box this morning, that they're going to come up with another cut while none of the other Fed governors have said it. So I think the market might also be in for a little bit of a disappointment coming up, which increases the need to be cautious.
Okay. So David, where would you be putting money to work right now?
Well, you notice in the month of November, it was not a risk-off month. I mean, you have things that are impossible to value, like Bitcoin that dropped 30% intramonth. We talked about some of the AI trade. Healthcare was up double digits. Consumer staples, the dividend growth type things that we focus on picked up about 800 basis points relative to the S&P on the month. That doesn't mean that trend continues. It just does indicate that, like some of the other periods where expensive tech fell off, 2022 is the most recent memory, it doesn't mean everything falls off, that there is often a rotation in the better value sides of the market. Michael here with us is one of the better growth managers I know at buying reasonable valuations. That's all I'd recommend, not to get out of risk, but whether it's dividend growth, value type things that we like, or growth at a reasonable price, that's all different than buying things at 60 times earnings you hope go to 80 times earnings.
Michael, I'll put the same question to you, especially as we do look not only to the end of the year, but to 2026 here.
Well, let me give you a little bit of caution about being overly cautious too. Morgan, follow on what David said, but particularly if you think about NVIDIA. Here's a stock where everybody's saying, okay, they're spending too much on the hype and expectations of AI that might not be realized. And yet we know that NVIDIA reported like 60% year over year gains in earnings. They've got $500 billion in orders on chips for 2025 and 2026 combined. They are delivering numbers. And you do get, with new emerging technologies, this period in a stock's life where sometimes they're just overvalued, like Amazon was for years based on historical metrics, but they continued to deliver. Will that happen or will it not happen? It's very hard to bet against some of these stocks, but if you really do stick with a valuation discipline, you really have to look askance at them. So I think there's great opportunity coming into 2026. I think any number of value stocks should be balancing out your portfolio. Healthcare has been doing very well, but I also think some of the energy names still have further to run based on this pullback. And I think that there are still opportunities in some of the consumer durable stocks. So they're out there, but you have to look for them and you have to work hard. And don't throw the baby out with the bathwater on even these bigger stocks.
Okay.
The value may materialize.
All right. Michael Farr and David Bahnsen, thank you both for joining me. I think we have a New Year's resolution here, and that's to get you both on set to reunite you in person together. Just throwing that out there right now.
It'd be great fun.
On this Black Friday. Okay, great.